Welcome to the 3 Edge Week in Review for the week of August 14th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge. I'm joined here once again today by Steve Cucchiaro, the CEO and the Chief Investment Officer here at 3 Edge Asset Management. It's kind of an exciting day because we're broadcasting today from our new Boston office, which is located in the heart of Boston's financial district. This week, Steve and I will be discussing the potential for the return of the bond vigilantes. And this is a term that was used extensively in the 1980s and the 1990s when investors were concerned about expanding growing government debt and higher rates of inflation. And we're going to talk about what the current environment today might mean for this potential return of the bond vigilantes. But before we get to that, quick recap of the activities this week in the markets. August has actually been a difficult month across asset classes. Both stocks and bonds are down month to date. Declines in the equity markets have been led by Chinese equities, which are down currently around approximately 8.5% on a year-to-date basis. Investors seem concerned about the prospects of economic growth in China, and the value of the Chinese currency, the yuan, has declined to, I believe, a 16-year low at this point. In the U.S., the consensus now remains that in September, the Federal Reserve, at their next FOMC meeting, will not raise short-term interest rates. They will pause, if you will. And so most market participants expect that to happen. So what will happen as we get through the end of August, people will be focused on the Jackson Hole Symposium. This is an annual event where the Federal Reserve meets, and the chair of the Fed during this meeting gives a major address. And so everybody will be focused on what Jay Powell says at the symposium to see if there are any clues about what may lie in store in terms of Fed policy. And then more general terms, we still have a very robust labor market. So the labor market remains strong, although it's beginning to soften, and economic growth in the consumer remain fairly resilient. So we have inflation coming down, an economy that remains fairly strong, fairly resilient, but an inflation rate that's still above the 2% target for the Fed. So we'll have to see how things develop as we go through the rest of the year. So let me bring Steve into the conversation here. And Steve, let's talk about bond vigilantes, an expression that was very popular in the 80s and the 90s. Really haven't heard much about it over the last decade. What were the conditions back then that brought these so-called bond vigilantes to the fore? And then later on, we'll get to, are the conditions similar today? But let's start with a little bit of history. Who are these bond vigilantes?
Well, Fritz, as you know, inflation is the enemy of the bond investor. When someone buys a bond, they are getting a fixed stream of interest payments out over time. And their hope is that what they receive is over and above the rate of inflation, because inflation eats away at the value of that fixed income stream. So bond investors hate inflation. And in the 70s, 80s, and into the 90s, there was so much concern about inflation that the way that the bond investors would protest would be to sell their bonds, force yields up, and try to convince and encourage governments and the Federal Reserve Board not to introduce inflationary policies. And so they basically intimidated the market. And those bond traders the term was coined, bond vigilantes. Now, back during President Clinton's administration, one of his advisors famously was quoted as saying, if there was reincarnation, I want to come back as the bond market. That way I can intimidate everybody.
I remember that, yeah. So now, what are the conditions that we see today that could bring back the bond vigilantes?
Well, back when bond vigilantes were very popular, the concern was how to bring down inflation. Inflation was on everyone's minds. But as you can see from the accompanying chart, inflation and interest rates came down quite steadily from 1981 all the way down to 2020. And the Fed was no longer worried about fighting inflation. In fact, they were more concerned with fighting deflation. And they were even struggling to get inflation back up to their target of 2%. So there was never a thought about bond vigilantes. Yields came down from over 15% in the 10-year bond all the way down to less than 1% by 2020. So it was just not in anybody's mind. Now, since then, we've had a resurgence of inflation. The Fed said, well, it's transitory, not to worry. And bond yields started to climb, but not so quickly. And then when the Fed finally acknowledged that inflation might be more of a serious threat, that's when yields started to go up. And now we have a case where, as you mentioned, inflation's come down from its peak of 9% more recently down to 3%, but it's likely to be sticky here with wages growing more than 3% a year, in fact, 4 or 5% a year. We might see inflation continue to rebound and stay above that 2%. So inflation now is a concern. And the Fed now is forced to be thinking about how do we get it back down to 2%.
Okay, great. So inflation, clearly more of an issue now than it has been for decades. Also, what about government debt, though? Because I think that was part of the equation in terms of what the bond vigilantes were trying to do.
Well, remember, bond vigilantes, when they protest, they not only protest against inflation, but against government policies that might stoke inflation. And ramping government spending is a policy that could really alarm those who are worried about inflation. And just in the last couple of years, we've had tremendous increase in fiscal spending, right after we had tremendous monetary stimulus from the Fed. And the Trump administration spent over $2 trillion in stimulus plans. The Biden administration has spent around that amount since. This is a tremendous amount of fiscal spending. And it's money that the government doesn't have. This is all borrowed money. This is making the debt go to record levels. Now, if you see in this next chart, debt is now $32 trillion and climbing rapidly. The interest expense that the government has to pay on that debt, however, had been low because interest rates were so low. You can have a massive amount of debt, but if the interest rate is so low, you don't worry. And I think we got a lot of complacency. Well, now that interest rates are climbing, the annual interest expense on the debt, you can see from this chart, is already approaching $1 trillion a year. And it's easy to do the math with the way that the debt is climbing and with the government having to roll over that debt. We could easily be approaching $2 trillion a year in the not too distant future. So this is really a crowding out with the government debt and a sign that this could be very inflationary.
Okay, excellent. So my final question, as always, based on what we've discussed today here about bond vigilantes, about inflation, about rising government debt, how might investors think about adjusting their portfolios in the times in the year ahead?
So one direct impact on an investor portfolio would be on the fixed income allocation of that portfolio. Even though there are a lot of experts and economists who think inflation is all going to go back to the way it was a few years ago, back down to 2% or less, and bond yields will follow, we certainly see the risk of inflation continuing to climb. And therefore, we think on the fixed income portion of one's portfolio, there's unnecessary risk taken by buying bonds with too high a duration or maturity, out 5, 10, 20 years. So we favor short-term treasuries. Now, in addition to that, unlike many who think that the recession threat is gone, we think perhaps it's just been delayed and there's still a threat of recession. So therefore, we would favor treasuries over corporate credit because credit spreads are narrow right now. And if the threat of recession does appear, credit spreads will start to widen and people with corporate bonds, especially junk bonds, will lose money. So in terms of the fixed income portion of the portfolio, we still favor short duration treasuries. Now, the chart that I showed last time about the government debt, a lot depends on, do we have financial repression? if the government goes to the Federal Reserve Board and says, look, we can't take this amount of interest expense. This is going to kill our budgets. It's going to crowd out our other spending. Please help us. Please go back to quantitative easing. Please buy this debt to keep interest rates below the rate of inflation, like what happened after World War II. Then this would certainly be a very big boost into gold, because when real interest rates go negative, gold does very, very well. So that would be the other implication.
All right, great. Steve, thank you very much for your insight, your explanation about the term bond vigilantes and why we should pay attention to that these days based on the current environment. So that will do it for Steve and me for this week. We'll be back next week with another edition of the 3 Edge Week in Review. In the meantime, all of our videos are always available on our 3 Edge YouTube channel. All you need to do, you go to YouTube, type in 3 Edge, and you'll be able to see our entire inventory of videos there. We also have not only the videos, but written content available on our website, and that is 3edgeam.com. And so on behalf of Steve and everyone here at 3 Edge, thanks for listening.